Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Investment Strategy Update. Today's Friday, October 7th. Well, this bear market continues to ramble on. September was a terrible month. So far, October has seen some volatility in its early days with a couple of strong up moves, followed by a couple of strong down moves. Our market model continues to deteriorate with individual indicators pointing down. Our recession models continue to deteriorate as well with some further readings into recession territory. We're going to update you on all this in today's update. If there is a bright note, we are coming to the end of the seasonally weak period, particularly in midterm election years. The best quarter of a presidential cycle is the quarter we're in right now, the fourth quarter of the midterm year. That's followed by the second best quarter, the first quarter of the third year of a presidential cycle. So we're in a sweet spot seasonally for some sort of rebound to develop. But right now we would view any rebounds as being temporary, short, or intermediate term in nature. For there to be a major turn in the market, we believe there would need to be a change in Fed policy. The Fed continues to raise interest rates rampantly. It's causing a lot of volatility in various markets around the world. We're seeing currency markets very volatile, bond markets very volatile. And unless they change that policy, we don't believe there could be a significant turn in the market. So let's start today by taking a look at our market model dashboard and some of the specific indicators within it. So let's start out by looking at our PAS dashboard. You can see all the arrows are pointed down. The second sell signal occurred 17 business days ago on September 13th. A couple of weeks before that, our recession warning models confirmed a recession warning. So we expected that mid-summer rally attempt to be a short bear market rally. The first sell signal in our model this year came in April. And before that, there were tactical sell signals going back even into last year, 2021. There was a warning from our 210-day indicator in January. All of those tools helped us position portfolios to preserve your wealth. And that's proven to be the right approach this year. We've even been able to make some minor positive progress with inverse funds in our most aggressive strategies, the PAS stock and PAS ETF strategy. You can see the core indicators all are pointing lower. We're going to give you a quick update on each of those in a minute. Tactically, we're getting to the lower end of the range. The 10-week chart is at 24%, so it's at its lower risk level. The overbought, oversold indicator came very close to hitting oversold about a week or so ago before bouncing up. It's currently about 2.5% below the bear trend average. Let's start with taking a look at the overbought, oversold indicator. So here you could see the overbought, oversold indicator and the channel, what we would call a bear trend channel. This starts with the first sell signal, April 22nd of this year. And you can see the market's traded very well inside that channel. This was that short period where the model did flip back to positive in August. Again, we saw that recession indicators were moving towards recession. We didn't think that buy signal would last very long, and it didn't. And we got the second sell signal going back a couple of weeks ago. Last week, we came very close. It did technically come just short of hitting the oversold level, and now it's bounced up towards that bear trend average. But while we're in a bear cycle, we expect the market to trade in this channel. When it gets to the lower end of the channel, we would expect potential moves to the upside. When it gets to the upper end of the channel, we would expect it to move back to the downside until our major market cycle turns back positive. That's how we would expect this bear market to play out. Let's take a look at some of our core indicators, starting with the universe trend indicator. So here are the two universe trend indicators, the logarithmic and traditional scale. They continue to drop after taking a bit of a breather in July and August. In fact, the traditional scale did reverse up temporarily, but now it's reversed back down in September, and in fact, it moved below the previous low, which is a bearish sign. The logarithmic version hesitated in July, never reversed up, but then continued to move down in September. This is one of our proprietary indicators to help us understand market trends, risk levels, and potential turning points. For those of you not familiar with this indicator, we're taking over 4,000 stocks globally that are inside our research database, and we're putting them on a specific charting methodology that records positive and negative trends. And all of that is relayed onto this chart, which is the percent of those 4,000 global stocks that have a positive trend. When the percentage is increasing, we record that with a rising X column. And when the percentage is decreasing, we record it with a declining O column. And this is point and figure style charting. So you can see, for example, the current traditional scale chart is 35.473%. We record every 2%, so as it's been dropping, 36% is recorded right there. If this number drops to 34%, we'd have another O in that column. Now, the reason this indicator is so valuable is it helps us understand how many stocks are strong or weak. We hear about the Dow and the S&P doing this or that, but those averages are heavily weighted to the largest companies and aren't necessarily indicative of the market's underlying strength or weakness. This is an early warning indicator in our model. For example, we could see the peak came last year. That 5 right at the top of that chart, of that X column, indicates May of 2021. That's when the high point was reached in this indicator. Over here on the traditional scale, it was April of last year when the high point was reached. Now remember, the market continued to move up well beyond April and May of last year. In fact, until the very end of the year and even the early days of this year until it peaked. That's what we call a negative divergence, where these breadth indicators, the number of stocks with positive trends starts to fall, but the market itself is moving up. That tells us that internally the market is weakening. And you could see that at major tops in the market. For example, if we go back here to 2007, the high that year came in April on the traditional scale chart, and it started to reverse down in August. The market peaked later in 2007. So this is a good indicator to help us understand when the market is weakening underneath the surface, and that often then leads the market indices with a downtrend. And the reverse is true at bottoms, right? We tend to see a positive divergence build. For example, in 2008, for both of these charts, as you can see on the screen here, the lows came in October or November 2008 with this indicator. That's when the highest percentage of stocks had downtrends, or the lowest percentage had uptrends. The market continued to drop until March, but you could see these numbers actually started to improve. That was a sign that a major turn higher in the market is coming. So far this year, it's been a straight shot down in the logarithmic version of the chart for about a year. Reversed down in November. Actually, the number started slipping even well before that with the high in May, and now we're down to 44%. There's no sign of a turn at this point, right? So even if the market rallies into this seasonally strong period, as I mentioned earlier, we expect it to be a short-term rally, not a turn back to a bull cycle. Not until we see a positive divergence develop on this chart. So of the core indicators, the universe trend indicator is the leading indicator. The cash comparison and long-term momentum indicators are the actual ones that tell us when the cycle is changing and turning. So here are the two cash comparison charts that we record, a logarithmic chart and a rate of change chart. And you can see both hit their peaks in November of last year and then started to turn down at various times. The rate of change chart turned down in January, followed by the relative strength chart in February. Now, both of these have now moved into what we would call sell signals on their individual charts. In fact, the logarithmic chart just did that last month when this little rally attempt in August was turned back down, and now we've moved below the June low. We've seen a series of lower lows and lower highs as well on the rate of change chart. So this tells us that cash is a better investment than stocks. When the trend is generally rising, stocks are a better investment than cash. When the trend is declining, cash is a better place to be than stocks. If we go back to 2008, you see a similar pattern set up here. And that pulled the rug out from underneath the market into a major decline in 2008. So this chart turns with the market and actually causes our buy and sell signals. The universe trend indicator warned that the market was weakening. This one confirmed that the cycle was changing. And the long-term momentum indicator is another confirming indicator moving with the market cycles. Well, you can see this year the indicator turned negative as noted by the red shaded background at the end of January. We update this indicator at the end of every month. So this one's updated through the end of September. So since January, it's been negative as the market's been dropping. Now, if we look at more history of this indicator, here you can see 2008 when the last major turn occurred. Right? We showed you how in 2007, the universe trend indicator turned down early. And then in 2008, also in January, the long-term momentum indicator moved to negative status. And that confirmed that the turn was taking place where the universe trend indicator warned us that things were deteriorating underneath the surface. And back in 2000, you could see that turn as well at the end of June or July. Those were the two major bear market turns in the last, say, 20, 25 years. And now we have potentially the third major bear market turn this year. So that's a very high-level description of how our model is designed to help us identify potential bear markets. No other model like this exists to our knowledge. We believe this gives us an edge, especially in today's volatile economic environment. In our experience, not many other money managers or advisors have an acceptable answer to handling a bear market. If you ask them how they handle a bear market, I find they usually dance around the question and say something about keeping you diversified. They might pull out a long-term chart of the stock market and tell you how that historically writing out downturns is your best bet. But that might not work in your time frame. You don't have 20 or 30 years in many cases to recover lost money. So here's a long-term chart of the S&P 500, and it's recorded with bear markets and recoveries, bear markets and recoveries, and then when you're making new progress, and if you just write out every market downturn, it could be a long time before you're making new progress. In fact, somebody who started to write out this downturn in 2000, that took a couple of years to play out and then recovered. And then there was another major bear market, which took many years to recover. And that was a 13-year period from 2000 to 2013 before a passive investor started to make new progress, right? And that doesn't even include the inflation impact on your money. That's just getting back to where you were 13 years ago. So that's why, we take a very clear and proactive approach to bear markets. We've invested substantial time and resources in building all of these tools and our quantitative models over many years. The resulting research helps us identify market trends and potential turning points. That intelligence helps guide us in our vigilant efforts to preserve your wealth. And I know that many people will tell you to not ever move out of the market to the sidelines because you can't possibly do that accurately. But in our view, they say that because they haven't taken the time or invested the resources in conducting the research. We have over many years, and we believe having a straightforward approach to handling a bear market is critical in preserving your wealth in this bear market and other ones in the future that we're certain to confront. Now let's take a look at some of our economic modeling. We continue to see these numbers pointing down. The latest reading in our monthly leading index moved deeper into negative territory. The weekly leading index has also moved into further negative territory. These are designed to move into negative territory ahead of a recession. The gray bars are the recessions. So you can see the weekly has a good history of warning of a recession. The monthly as well, there are two lines on the monthly chart. One is a longer leading indicator, and then there's the leading indicator, the red line. So the blue line tends to lead the red line, and you can see it did so far during this cycle. Each time that happens in the past, eventually there's a recession. So we believe that it's almost locked in at this point that we're going to have a recession probably sometime in 2023. And the reason that knowing if a recession is coming is so important is because I know we're showing this chart repeatedly ad nauseum, but it's important to understand bear markets coupled with a recession are much worse than bear markets without a recession. And that's why we haven't had a major bear market in the last 10, 12 years, 14 years, since 2008. That was the last recession. There was COVID, but that was a different type of recession. That was a government-driven recession. It wasn't a cyclical-driven recession like these other ones are. So this shows when you have a recession, bear markets are more severe. Bear markets without a recession are much more mild in terms of how much they drop and how long they last for. And you can see all these red diamonds are the recession-driven bear markets, and you can see many of them last 300, 400, 500, even 600, 700 business days. The average drop is 36%, but some of them are 50+%. Well, where are we today? Well, we're about 200, a little over 200 days into this bear market. If we see that it peaked first couple of days of this year, according to the S&P 500, where we are today, at the bottom, it was down about 25%, so maybe the current recording would be right around here. To get to the average, there's more to go, more time and more downside. And if it's one of the severe ones, there could be a lot more time and a lot more downside before it's over. Well, let's end the day with a little bit of light news, right? We've been striking a very bearish tone for many months now. It's been the right approach. But let's look at something that has a little bit of a silver lining, and that is seasonality. What we're looking at here are average 2-quarter market performance by presidential cycle. This is the last 100 years in the Dow Jones Industrial Average. We just finished, according to the presidential cycle, the 2 worst quarters, and that's the second quarter of the midterm year followed by the third quarter of the midterm year. Those are the worst back-to-back quarters according to this type of analysis. It's in the past. That ended last week, September 30th. The best 2-quarter performance is the fourth quarter of the second year and the first quarter of the third year. We just started that in the last week. So seasonally, we're in the sweet spot. We tend to see a bottom right around the midterm election. We tend to see a strong finish to the midterm year, followed by a good follow-through in the first quarter of next year. This is another good statistical analysis of midterm election years. You tend to get big drops during the year. So these are all the midterm election years going back to 1962. The lowest mid-year drop was 7%. The worst was 38% here in 1974. Right? We've seen plenty in the mid-20s like we've had so far this year. This is 1 year after the low. You tend to get significant and dramatic rallies following the low of a midterm bear market. Now, none of this overrides our models. Our models are negative. We position for negative, but this does open up the potential for some sort of opportunity developing over the next several months that could be a little window and opportunity to make progress within a longer-term bear market. Now, we think it won't last long if an upturn takes place. We think that would require a major turn in the Fed policy. That could always happen, of course, but without a change in Fed policy, we think the seasonal pattern could lead to a short or intermediate term opportunity. So we continue to be on the lookout for that. We don't think we're at that point just yet, but we will keep you posted if we see that developing in the future. Well, that's going to wrap up this update for our proactive investment strategy. I hope that you saw some insightful information and this helped to clarify our current strategy and positions. Have a great weekend. We'll talk to you again in a couple of weeks.